If you're new to investing or starting out or simply want to improve your financial knowledge, we'll hope you're in the right place. Because the one thing we don't teach people is about personal finance to think it through. So hopefully you can take the right steps. My name is Dave, I work in financial services and I help people access their private or work pensions. Most people can be in Asia. So the aim of the video, my finance blog, is to improve people's financial knowledge so you can reach your goals just like me, which allows me to become a net millionaire in my early 50s. So if I can do it, you can do it. Now let's get into the latest video. Now this video is not to boast or brag, but to say look at me, but it's my self-invested ISA, shall we say, for the month of March 2026. We're looking for annual growth of 10%, we're looking for daily dividends of £6,000 and a year-end fund value of around about £215,000. So how have we done in the month? Well, not a great month, but down 4.39% because of what's happened, shall we say, in the Middle East conflict. The FTSE is up around about 2.4%. So in the month, we lost £15,500. So it just goes to we have good months and bad months. We started at 186,585 and we finished at 171,226. Contributions not great this month. We put £60.14 in, £805 year to date, but we will increase contributions substantially in April and May. Our platform provided charges fees of £22.83, and it just goes to show we're not going to use the allocation of a year. We put in just over £7,500 during the last tax year. So where exactly are we held within the portfolio? Well, UK and Europe nearly 58%, USA and Americas 32%, and Asia and emerging markets nearly 10%. And we did receive some income in the month. We received one dividend from Barclays, the banking group, £95.14, 23 new shares reinvested, cost of £1.50. But across our portfolio, we've got a yield of 5.36%, and that's been increased in the month as share prices have dropped. But year to date, nearly £200, well below our expectations, but we've had some great results and we will be back on track, shall we say, by the end of May. The holdings within the portfolio. Now, my own personal opinions, we see no reasons why we're going to sell any shares in the foreseeable future, but it's what we call buy and hold. So we own 10 shares, 9 in profit, 1 showing a small loss. 47% of our portfolio, 43% in the FTSE 100 and 4% in the FTSE 250. Total share values collectively is just over £81,000. Now our shares have struggled, shall we say, during the month because what's happened in the Middle East, but all good names. So a quick summary of what we've got. We own Lloyds Banking Group, 21,000 shares. Just below £20,000, 11%, but very good results recently, very nice yield, and it will pay nice dividends during the month of May. We own L&G, the insurance group, the pension provider. 5,601 shares, £14,000, 8% of our portfolio. Had great results, got a yield around about 8%, one of the best performing yields in the FTSE 100, but it is cash rich, it is generative, and everyone needs insurance. On that note, we also own Aviva, just over 2,000 shares, £12,000, 7% of portfolio, a yield around about 7-8% again, but again very cash rich. Has been on a buying spree, recently it's for Direct Line, but a long term hold. And again, a very nice dividend payable in the month of May. We also own NatWest Banking Group, 1,282 shares, £7,000, 4%. Has struggled during the month, but it was one of the best performing shares of 2025. But now the shackles are off, it's not owned by the government anymore, it's got a free rein. We own HSBC, 561 shares, £7,000, 4%, and it will pay a nice quarterly dividend at the end of April. But away, shall we say, mainly from the UK banks, more about China and Asia. We own Barclays, 1,722 shares, £7,000, just under 4%. Again, very good results. A year around about 4%. Will pay a nice dividend, shall we say, at the end of May. And then we own Standard Life, originally what we call Phoenix Life, the pension provider. It's what we know about. 688 shares, £7,000, nearly 3% portfolio, but a yield of around about 9 to 10%. Very good results recently. Is catch risk, is generative, but it does specialise in what we know about pensions, shall we say, workplace pensions, buyouts. Away from the banking sector, we own our platform provider AJ Bell, or You Invest. Nearly 1,000 shares, £4,700, nearly 3% of our portfolio. Very cash rich, customers are growing, shall we say, assets are growing, everyone's using the platform, shall we say, selected companies. But it is what we see as a growth company. Pays a smaller dividend, smaller yield, but it is, shall we say, expanding. Away from the financial services, we own Sainsbury's, the retailer. Everyone needs food, everyone needs to eat. It's been ever a price war with Aldi, but we own 965 shares. Just over £3,300, 2% of our portfolio, but good results are out. It's making nice profit margins, but what will happen, shall we, about the cost of living crisis moving forwards. And then finally, we own Card Factory, 4,187 shares, £2,500, 1.5% of our portfolio. Had good results, like you said lately. It's still expanding on the high street. It's tried to do online presence with not much success, but it is paying a good dividend. It is a good company, but it's affected, shall we say, cost of living crisis, minimum wage increases, inflation. But we see no reason we're going to sell any shares under what we call buy and hold long term, but they're my own personal opinions. So to summarise, we've not had a great month of dividends, but we've had some great results. Now those dividends will be paid, shall we say, April, May, and we will be back on track. They're my own personal opinions. If you like videos, smash the like button, subscribe to the channel. Now let's look at the funds we held within our portfolio. At the moment we're down to 7 funds, 5 in profit, 2 in loss. 54% of our portfolio, worth nearly £90,000. Now our funds have, shall we say, also reduced during the month because of global exposure, but it's something we're going to do to simplify. Again, all long-term funds, we're not going to sell probably 1 or 2, but there's a reason why we bought them. Our largest holding is a Fidelity World Index, £28,500, and we have been topping up. 17% of our portfolio. Fees of 0.12%. It owns around about 1,500 stocks, and it gives an annual yield year on year of around about 10%. We just switch off, but has been affected in the month. We own a passive ventures fund through our platform provider AJ Bell. £28,000, 16% of our portfolio, but it was done, shall we say, for the diversification. Again, very low fees, annual returns over 10%. We just switch off. We own an LNG technology fund, £20,000, nearly 12% of the portfolio. Slightly higher fees of 0.3%, and it runs around about 250 stocks, predominantly US based. But it has been a great run, and again, we just switch off. Now, 2 funds have struggled recently is a Fidelity China fund. We've got nearly £3,000 in, 4% of our portfolio. China ever said that it's going to come back on track, but we're showing a small loss. Now, if it does get back in profit, we're going to leave that fund and put into our passive funds, but we're not going to sell at a small loss. Okay. And finally, a Russia fund. We put £500 in. It was worth over £600. It struggled ever since the Ukraine conflict, but it's only £326. 0.91% of portfolio. Will it ever get back in profit? But we're not going to sell at just a loss. But thankfully, it's only a small amount. So you're not going to get every decision right. And 2 funds we own finally what we've called ring fence for a specific purpose. We put £3,000 in. S&P 500 fund is now worth £3,700, but 2% of our portfolio. And we own a FT All World Index fund. We've got £6,500 in, nearly 4% of the portfolio, but it was done for the division. Now we didn't want to add into our existing holdings, we were separated, but we've done it for a reason. Simple, low-cost funds we can get at a greater rate, but it just switch off. So it just goes to show you're not going to get every decision right. We've struggled in China, we've struggled in Russia, but we're in, shall we say, simple, passive, adventurous funds. And we're meeting our objectives until the Russian conflict or Ukraine conflict or the Middle conflict. Okay? But it just goes to show you're going to have good months, you're going to have bad months, but we will meet our objectives later this year. hopefully 10% return, £6,000 dividends on a value of £215,000. Now, it's not to say look at me, it's to give people hope. If you invest on a regular basis, pick simple funds or shares that pay dividends, reinvest dividends, and invest within a tax free offer, you can meet your aims or objectives. So check out my other videos, check out my blog posts, and we'll see you again in the next video.